On June 12, SpaceX rang Nasdaq's bell and everyone thought it had won. The IPO priced at $135 and retail apps lit up almost immediately. Yahoo Finance reported $75 billion raised in one day. That topped many countries' annual spending, while SpaceX closed up about 19%. By the closing print, SpaceX's valuation sat around $1.77 trillion. That was larger than all but a handful of national GDPs, and Elon Musk crossed $1 trillion in net worth for the first time. That is the size of a major economy, and waitlisted buyers clicked buy. You know the feeling. Months outside the club, then one green button. But some buyers received as little as one share allocated. That meant the crowd was excited, but it was not actually in control. Here's the part the app did not explain that morning. SpaceX waived the usual 6-month lockup so early holders could sell, and the first consequence was simple. Supply could hit retail anytime. Buyers saw upside, while professionals watched the exit. An IPO also lets private holders get liquid. The app shows demand, while the allocation sheet shows access. One side clicked buy, while the other could sell. That is not a conspiracy. It is the structure working. 14 days later, Jeremy Grantham of GMO walked on to CNBC. He said, "This is the most expensive market in American history." That sounds dramatic until you see what he measured. The Buffett Indicator compares all United States stock value to the economy. Basically, it asks one blunt question about price versus output. How much are investors paying for every dollar America produces? Warren Buffett, Berkshire Hathaway's chairman, wrote that near 200% you are playing with fire because prices tower over output. On June 26, that gauge reached about 235%. That meant United States stocks were worth more than twice the economy. And that is where SpaceX stops feeling like a victory lap, because its debut landed on the scoreboard Grantham had been warning about. Grantham was not describing some ordinary market pullback either. His route back to trend looked closer to 70% down. It was not gentle, not tidy, and definitely not app-friendly. His example was Amazon, which survived the bubble yet still fell 92%, so survival and stock pain can live inside the same company. Now go back to SpaceX, because the chart had already turned. It touched $225.64 on June 16. That was its all-time high, and then sellers started pressing harder. By June 27, TradingView showed it trading near $153. That was roughly a third down from the peak in under 2 weeks. That is the human cost, because somebody bought the top. Now look from the other side. The institutions that received IPO shares at the deal price had real options. Selling into the frenzy meant locking in instant gains. But anyone holding shares near that high saw a very different screen. Mostly, that was an ordinary buyer who finally felt included. And that feeling matters because access can look exactly like fairness. But end-of-chain access is still late. This is not a buy or sell call. It is who traded with whom. One app showed green, while one desk saw a chance to exit. And Grantham's gauge explains why those screens can disagree. Two markets are running at the same time. One is what your app shows, and the other is what valuation measures. SpaceX minted a trillionaire as the whole market flashed expensive. Both sides still belong to the same trade.